I've heard you mention a couple of times on a competing network the possibility of reducing aggregate demand in order to keep inflation down. And I'm wondering if that just means cutting government spending a la Doge, or are you really willing to slow down U.S. economic growth in order to hold prices level?
No, we're absolutely not willing to slow down economic growth, and we will not. In fact, President Trump is telling everybody that we're going to have a golden age, and we're hatching a plan to do that. But the bottom line is that, as you know, you just talked about the CPI, that the economy that we inherited from President Biden keeps looking worse and worse. So that their jobs record was revised down by 1 million jobs just a week ago. And now we're seeing that core inflation and top line inflation are really, really above the Fed's target in the latest report, which is really the last report for the Biden administration. The Trump administration has a really aggressive plan to fix the disaster that the Biden economy became. And in fact, if we go back and look, right now, it's the case that Americans are still paying something like $1,200 a month less or more for the same amount of stuff because of this inflation. And egg prices are up 100% in the Biden administration and so on. So there's a lot of work to do. But the way you get inflation down is you do micro things. And we can talk about those micro policies, like how do we address the avian flu? We're all over it. But then you do macro things, too. And the macro things are to get aggregate demand, all that massive government spending, $1.5 trillion a year more than we thought it would be this year, back when we looked ahead in 2019. So you got to get that spending down, and then you got to have more supply-side policies like deregulation, drilling, and tax cuts.
Well, let's talk a bit more about inflation and how you plan to address it, because a lot of people looking at these numbers are saying this doesn't even factor in the impact of tariffs here, tariffs that have just been put in place, but also potential tariffs to come. So how do you plan the administration to actually lower prices if these tariff policies come through?
Again, in the end, inflation is very much a macroeconomic phenomenon, and it depends on balancing supply and demand. And you guys might recall that when the big runaway stimulus bill that the Democrats passed was first passed, that even before inflation began, my friend John Cochran and I out at Hoover wrote an article at National Review, and we were talking on TV about how this is probably going to be about 7% inflation that year. And so it's not rocket science. It's not really hard to calculate what happens. What you have to do is have a lot of supply and reduce demand. And if you do that, prices go down. And so a big positive supply shock with more constrained government spending is going to fix the problem. But meanwhile, we're not just waiting for the macroeconomy to turn. We're also going after the micro issues one by one by increasing energy supply, reducing regulations that are very costly, and even going after, again, very targeted things like what are we going to do about the fact that Joe Biden last year killed 130 million chickens, and that's why egg prices are so high. We're putting together a plan to manage the avian flu in a much wiser way. And so we've got an all of the above approach on inflation. And so this bad number, just remember, is closing the books on what Biden has done, which is allow inflation to get out of control. And the Biden people that he chose are also, complicit in this. You might have looked that Austin Goolsbee, the Chicago Fed president, just gave a speech a couple days ago saying, hey, inflation's under control. And here we see that we're looking at a 3-month moving average above 4, right? So that's not what the Fed should be saying right now. And it's not true, but we're going to fix it, with or without the Fed, because we understand macroeconomics.
You do have the president talking about wanting lower rates, but when you do have inflation as it stands well above the Fed's target persistently, and an increase in many aspects of the American economy as well, how would you then lower rates into this environment? Wouldn't that be considered imprudent given where inflation stands today?
It goes back to actually proving what we were just talking about. If you go back and look at what's happened to the 10-year yield since Treasury Secretary has been there, since Doge has started to make real progress cutting spending, then we've gone down. We went up. We're up 11 today on the bad inflation news, which is backward-looking, a Biden failure. But we're still many, many basis points ahead over the last week and a half, where there's all this positive spending news. And so I think that, instead of 409, we're at 464 looking at your screen. And all that progress is the early first few week progress of these policies that we're talking about. And so interest rates can come down if you have prudent macroeconomic policies, and we're doing it. And it's already reflected in Treasury markets.
Well, it doesn't look like Powell is going to be lowering interest rates. I mean, how can they if inflation is re-accelerating like this? It won't be at the short end, will it, Kevin?
Right now, I think that all economists have, after lots of study, agreed that it's the sort of 5-year to 10-year rate that has the biggest effect on the economy, and that going down is a big positive for growth that's non-inflationary. And so to see 10-year coming down the way it has after we've announced our policies is exactly what markets should expect. And as you see the budget deals happen, I've had lots of positive conversations with members of the House. I'm going up to meet with the Speaker today. I think, actually, I haven't looked at the afternoon schedule yet, and we were, talking to Lindsey Graham yesterday. It looks like budget deals are really moving forward. When all that positive news starts to influence markets, then they'll respond favorably, is my expectation, and interest rates will come down, because instead of spending $1.5 trillion a year more than we thought we'd be spending back in 2019 when we looked ahead to this year, we're going to be spending a lot less. And one of the interesting things is that we're finding all of this wasteful spending through DOGE that nobody else in the Biden administration was looking at. And they were just spending money willy-nilly, throwing money out the window without even telling us what they're spending it on, we find. And now we're shutting that down. And Treasury markets are responding already positively and doing what President Trump wants, which is to get interest rates down so that we can have a stronger economy.
Yeah, 10-year yields currently higher by about 11 basis points on the day. One day doesn't make a trend. But Kevin, I want to go back to what you said, that you're going to fix inflation with or without the Fed. Of course, we've talked about lowering interest rates, but you have a vocal chorus out there saying that actually the Fed should raise interest rates. Mohamed El-Erian, one of them, saying that if the Fed believes in 2% inflation, they should hike rates. That should be their next move. Wouldn't working with the Fed here mean that you should be calling for higher interest rates?
Look, a lot of the people that were appointed by Joe Biden who are running the Fed have made a lot of mistakes on inflation over the last few years, starting with letting it get out of control by saying, oh, it's all just supply disruptions and so on. And then after they failed, then they put out studies saying, oh, it was all supply disruptions in order to cover their tracks. And so those same people are acting now. And one of the things we've seen is that the Democrats that are appointed to the Fed are willing to be partisan. And so you could go back and look, but the Fed, for example, after Donald Trump the last time was elected and before he was inaugurated, they raised rates. They raised rates, even though inflation was in the ones. And so the Fed's going to do what the Fed's going to do. But if we have really strong macroeconomic policy, if we have supply-side policies that increase supply and reduce aggregate demand because we're getting rid of wasteful spending, then inflation's going to go down.
I think back,
that's right.
I think back to what you were saying about the 10-year in particular, and the testimony just yesterday. You had a lot of senators asking about the 10-year as well and what control you would have over it. How do you control the longer end of the curve? What are the tools at your disposal, and is financial repression one of them?
It's Fiscal Theory of the Price Level by John Cochrane is a good place to look. And the bottom line is that if markets believe that we're going to be fiscally responsible, and they believe that we're not only going to be fiscally responsible with this year's budget, but that it's a long-run plan to do that, then the inflation level and the interest rate levels can both go down. And this is going to happen. We're going to be fiscally responsible, and that's going to influence markets appropriately.